We are now going to be looking at low interest loans and interest-free loans. Now, in the next couple of slides, whenever you see me referring to interest-free loans or low interest loans, please understand that they should be viewed in the same way, in the same light. So if I'm just referring to low interest, I'm also talking about interest-free loans. If I'm talking about interest-free, I'm also talking to low interest loans. Basically, what is a low interest loan and an interest-free loan? Before we continue, it's when I give you a loan, and instead of charging you interest at the appropriate amount, I'd charge you less than what I should. So it's not really market related. I don't want to use the term market related because you will see that we are going to be referring to the official rate of interest, right, and not the market related rate or market rate. We don't use that term here. We refer to the official rate of interest, which I'll explain in a second. But understand, just for now, view official rate of interest as almost being the same as market rate. It's not always the same, but it means that we are charging interest at less than that official rate or not charging interest at all. Now, whenever we see a situation like that where we're doing something at less than what we should, there are usually some tax implications around it. So this is discussed in section 7 capital C and section 7D to some extent. It's a little that's not as important. Section 7C is the most important. Okay, so the first thing we're going to talk about here is just when we give loans to a trust or not to a trust. Now, when we're giving it to a trust, I'm going to just add something here and say, or a company associated to a trust. That's not really as common. You'll see in a second. I'm going to explain what that means. But for now, just view it as to a trust or not to a trust. Now, this section 7C that we're looking at only applies in this situation when it goes to a trust. You'll see I make a comment here. It's likely a donation, and that's right. And over here, you'll see when it's not to a trust, I say it may or may not be a donation for donations tax. Now, specifically, I'm talking about donations tax. You'll see this little star here. I'm just bringing this to your attention so that at the later stage, you don't think that I was lying to you or anything here or missed something. What I want you to understand is that when you give a low interest or interest-free loan to a person, which is not a trust, it will always be considered a donation or a similar disposition for the purposes of section 7. Now, we're not looking at section 7 here, and I don't want you to worry about section 7 for now. Section 7 is a section we study when we're looking at trusts. It doesn't just have to do with trust, but we study it when we study trusts. So for now, I almost want to say you can ignore this, but you should just remember that it is here, and I also want to say here, flag it for when you study trusts. But even in that, at the time when we study trusts, we'll go through this quite a bit. So for now, just ignore that. Okay. So when this loan is to a trust or not to a trust, when I say not to a trust, it's, for example, if I give a loan to you as a natural person instead of giving it to a trust. Now, the first we're going to talk about if it's not to a trust. Now, guys, this what we're talking about here, this section, this slide, is not something that's very common to see in tests and exams. In fact, I can't recall actually really ever seeing it so far. So, what I want you to understand is this little example here will illustrate exactly what the issue is. The issue is, if I give you a loan, a low interest loan, and again, remember when I say low interest, I also mean interest-free loan. If I say interest-free loan, I also mean low interest, right? Just the interchangeable. If I give you a loan today and I don't charge interest on it, what I'm actually donating to you is the interest that I'm not charging. So let's say, for example, a loan amount is for 100,000 rands, and the official rate of interest, or official interest rate, if you want to call it that, is 10%. That would mean, thus, the interest equals 100,000 times 10% So 10,000 per year. Now, donations tax works that, in this case, what we're specifically referring to here, that you have to determine if there's a donation on the day that I make the loan. So if today I give you the loan, I have to say today if there is a donation or not. This section we're talking about here is not section 7C. Right, it's not section 7C. So just bring that in mind. So if I give you a loan and I tell you how long this loan is going to be outstanding for, so if I say it's 5 years, for example, then you can tell me that the interest that I'm donating to you is this 10,000 rands per year times 5, so 50,000 rands. And that would be considered a donation. However, if I don't tell you what the period of the loan is, and I know this might sound a little bit strange, but understand we're going to be looking at situations here where, for example, a father gives a loan to his son or his daughter or his spouse or to his parents. So those aren't normally commercial type of loans. Then I might say Mr. X gives a loan to someone and he does not specify the period of time. So he says, I might come back to you in 6 months and tell you to pay it. I might come to you in a year or 2 years or 5 years from now. Or they might even say, here you go, here's a loan, repay me whenever you can. How much is the interest then going to be that I'm donating? And again, I'm asking, what will be the interest today? Do I know today what the interest will be? I can't. So then it's not considered a donation. This is a conceptual idea here, guys. And again, it's not as important. So let me just show you in this example what I mean. So Mr. X sells a house for R1,000,000 and a market-related interest is 10%. If the loan is repayable in 1 year's time, there will be a donation of million times 10% times 365 over 365, so 100,000. If there is no term stipulated during which the loan will be repaid, then there will be no donation for donations tax purposes. Why? Because we can't determine what the interest will be. And again, it's just for today, on today's date. So obviously you can tell to me, but Ruan, what happens if the person repays you back after 3 years? And you can say how much interest was donated over the period. Yes, you're correct, but that's not what this section works, and that's not conceptually how it works. So this is just a concept. I am bringing it up here for completeness sake, guys, but I wouldn't worry too much about this slide. What is much more important is section 7C, which we're going to discuss next. Now, I want you to, before we start, you can see there's quite a lot going on in this slide. I want you to see this slide and the next slide, section 7C1B. They relate, well, they not relate to each other, they're both separate, but they have the same concept. So I want you to see this natural person is the same as this natural person on section 7.1b. This company that I'm talking about here is the same as this company on section 7.1b. The same goes for this trust and this company. It's this trust and this company. So I'm just pointing it out to you so that I'm only going to explain it once what I'm referring to with these different ones, but they're the same situation in both instances. Okay, so let's start with this natural person situation here. So we're looking at a situation where a natural person gives an interest-free or low-interest loan to a trust. It tells you also, or it could be a company at the instance of a natural person who is a connected person. I say it must be a connected person. So that will be, for example, let's say this natural person, Mr. X, he owns 20% or more of the shares in this company. That makes him a connected person. And so let's just, to make it simple, clear for the illustration purposes, which I think you'll all understand this. Let's say Mr. X owns 100% of this company. He now says to this company to make the loan to the trust. That is the same then, for the purpose of this section, as if Mr. X himself made that loan. Because he's basically just using this company as a vehicle to do something that he wants to do. Right, so just understand that. In both those instances, section 7C will apply, same with section 7.1b. Okay, then let's talk about this trust quickly here. There must be a trust, and you will study trust separately in a lot more detail, but for now understand a trust is a separate legal person. There must be this trust, and this trust must be a connected person to this natural person over here. When will a trust be a connected person to a natural person? If this person is a beneficiary of the trust. So the beneficiaries are the ones who get the benefits from the trust. So this natural person is a beneficiary, or relatives of that person are beneficiaries. So let's call this, just again, Mr. X for now. If the beneficiaries of the trust are Mr. X's children, or spouse, or parents, or grandchildren, right? So family members, relatives. If any of those people, or Mr. X himself, are beneficiaries of the trust, then the trust is a connected person to Mr. X. Okay, that must be. If the trust is not a connected person to this natural person, then this section does not apply. Okay, let's quickly talk about this company over here. This company is a company where this trust has 20% or more of the shares in this company. This company can also be a situation where the trust, so remember I said here, let's call it Mr. X, and I had beneficiaries here, Mr. X's children. Right, let's say there's child A. Let's say child A has 5% of the shares in this company, and the trust has 15% of the shares in the company. 5% plus 15% is 20%. Then that company, it's still the same type of company that they're referring to. So I'm just giving you the types of things there. Okay, but that's enough now. So now what I want you to understand is, I'm going to use it in the most, I'm going to explain it in the most, explain it in the most common way, but this is now for all of these situations I described. So if a natural person gives a low interest or interest-free loan to a trust or to this company, then at the end of the tax year of the trust, which is I want you to see what we see here, the trust is end of the tax year. Now the last day of the year of assessment for the trust is the 28th or the 29th of February always, right, depending if it's a leap year. On the last day of that tax year, you will do this calculation over here where you say, what is the interest that should have been paid on this loan at the official rate of interest, less the actual interest that was paid. That amount is then considered a donation that was made by this person. So even if this company gave the loan, this person is still going to be the one that pays the donations tax every time. Even if this person or this company gave the loan to that company over there, this person will pay the donations tax. Okay. So, the best way of now seeing it, I think, is really just this little simple example, and that explains it. So Mr. X gives a loan of 100,000 rands to Trust A. So let's call this Mr. X. Let's call this Trust A. Mr. X gives a loan of 100,000 to Trust A and charges interest of 3%. The official rate of interest is 10%. The loan is outstanding for the entire year, and Mr. X and the trust are connected persons. What is the donations amount? So, what is the interest that should have been charged? 100,000 times 10%, which is 10,000. What is the interest that was charged? 10,000 times 3%, so 3,000. So 10,000 less 3,000 gives us 7,000. That 7,000 is considered a donation that was made on the last day of the tax year. So you will still be able to apply all of your exclusions. If you haven't used your annual exemption and exclusion yet, all of those things will still apply. It's considered basically you paid it in cash. Okay, I refer here to the official rate of interest. What is the official rate of interest? The official rate of interest is defined in the 7th schedule to the Income Tax Act. That's a schedule that talks about fringe benefits. And it is the official, it's the repo rate, plus 1%. The repo rate is the rate that the South African Reserve Bank charges other banks. So if the Reserve Bank lends money to a bank, charges the repo rate. Right, repo rate plus 1%. So in an exam, they will either give you the official rate of interest, or they will tell you, for example, let's say the repo rate is 7%, then you need to know you have to add 1% so that the official rate of interest is 8%. Now guys, there's a note that you have to make here for yourself. I'm going to say, watch out. The official rate of interest is not necessarily the same as the market rate or the market rate. So why am I saying this to you? Because students don't often pay attention to this, and in an exam or test they tell you the official rate is 8%, the market rate is 10%, and then you don't know which one to use in your calculation. You always use the official rate of interest. Okay, that's the first situation. So now we're going to look at section 7.1b. So what I want you to understand now, this section, when this was introduced, a lot of people didn't like this section. So they tried to think of all sorts of schemes and loopholes to avoid this. So for example, you have to give a low interest loan to a trust or company. But what if you can give something to this company over here that's not a low interest loan or an interest free loan, but it still works in the same way? So for example, what if Mr. X, instead of giving 100,000 rands to this company as a loan, Mr. X goes and buys preference shares in that company, and those preference shares, we get all sorts of preference shares. You might, for example, get a preference share that's redeemable in 5 years. That's almost the same as a loan then. But then it's not a loan that you're giving directly. It's not specifically a loan. You're buying preference shares in the company. That was a way which people started using a loophole. So they introduced section 7C1b, which now says, if this person, or again, this company, which this person says to this company to go and do it, buys preference shares in this company, as again, this trust owns 20% or more of the shares in this company, this trust with beneficiaries. So it's the same, it's exactly the same, this company I referred to there. If this natural person, or this company, so let's just call it that, let's go with the normal one. So if Mr. X goes and buys shares in preference shares in ABC Pty Limited. Now I used an example of redeemable preference shares. It doesn't have to be redeemable preference shares, it just has to be preference shares. If Mr. X goes and buys shares in ABC Pty Limited, in ABC Pty Limited, this trust has 20% or more of the shares, this trust and a beneficiary in that company. Then they treat it as if this amount that you paid for those shares is a loan. And then any preference shares that this company pays to Mr. X, because now you've got preference shares in this company, any preference shares that this company pays to Mr. X is considered the payment of the interest on the loan. So, how would you determine the donation? It's the amount paid times the official rate of interest times the days over 365 less the preference shares paid by the company. So here's my example, and you'll see I've deliberately used the same amounts to make it so that you can understand the two examples. So Trust A holds 20% of the shares in ABC Pty Limited. ABC Pty Limited, this is up, is this company over here. On day 1 of the current year, Mr. X, again, Mr. X is this person over here. Mr. X purchases preference shares in ABC Pty Limited for 100,000 rands. The official rate of interest is 10%. ABC Pty Limited pays preference dividends to Mr. X of 3,000 rands. So this company pays Mr. X 3,000 rands in preference dividends. What is the donation? So again, Mr. X and Trust A must be connected persons. It's the same rule as previously. This trust must be a connected person. Right, what will be the dividend on that? So it will be the amount paid, 100,000, times 10%, and it was outstanding for the entire year. So 10,000 rands, less the preference dividends, which was 3,000. So less 3,000. That gives us 7,000 rands. That 7,000 is then the dividend. I specifically made it the same amounts to try and illustrate to you that what they're trying to do, it works in the same way. That 7,000 is then considered a dividend, a donation paid by who again? Always by this person. On what date? The last day of the trust, this trust's tax year, which is again 28 or 29 February. That's it. Section 7D just tells us then two rules. This won't really affect you. I'm just mentioning it to you. The first one it tells you is that the common law principles must not be applied when determining this interest that we calculate. So this 7,000 interest or donation amount, which is basically interest which was donated, they say we don't take this into account. Let me just quickly explain. So let's say you give a loan of 100,000 rands to someone. The common law of South Africa says the total interest that you've charged on this loan over all of the years, over its entire lifetime, cannot be more than the capital amount. So you can't charge more than 100,000 rands in interest, not in 1 year, over the entire life. This is just a law of the country, common law rule. They're saying this principle does not apply for Section 7C because it's not really interest, it's a donation amount. So they say if you end up saying that the interest that was donated is more than 100,000, that's fine. So guys, for you practically when you're doing calculation stuff, this won't affect you at all. I'm just mentioning it to you. But then they say you must not do compounded interest, you must calculate simple interest. What else compound interest work again? Let's just make sure everybody's on the same page. So let's say year 1, the capital was 100,000. The interest was 10%. So that's 10,000. Year 2, how do you calculate the interest? You calculate the same way. So it's always the capital, original capital times the interest. What is compound? Compound would have been you take that 10,000, you add it to that 100,000, so you say 110,000 times 10% equals whatever that might be. We don't do that. Okay, again, guys, if you didn't even know about this section, you probably wouldn't have messed this up in any case. Right, and then just one, Section 7C5, please work through it. This tells you situations where we don't apply Section 7C. A lot of it's not examinable. The only one I want to quickly talk about is Section 7C5D, where it says the trust used the loan to purchase an asset that will be used as a private residence by the person that gave the loan or that person's spouse. So let's go back to this first one here. So let's say Mr. X gives a loan of R1,000,000 to the trust, and the trust goes and buys a house. And Mr. X stays in that house and uses it as a primary residence. If that is the case, we don't do this section at all. Basically, what they're trying to say, that would be the same as if Mr. X went and purchased a house for himself. Okay, so just be aware of it. If they purchase a primary residence, it's not applicable. That's it.